Hello, good evening, everyone. Welcome to another panel of the International Week. My name is Jennie. I am an equity strategist at XP, and we are here tonight to talk about emerging markets. We have two guests with us to share their perspectives on where are the opportunities and risks when investing in the region. Before I introduce the speakers, I just want to remind everyone that this is the second day of the event. So if you missed the panels from yesterday, they are available on the website and on YouTube as well. Additionally, if you want to watch this in Portuguese or English, there are two links in the platform, so you can switch languages there. We will also be sharing a QR code on the screen somewhere over here if you would like to send any questions to our panelists. So at the end of towards the end of the panel, I'm going to pull some of them to ask our speakers. And for those who are watching on your cell phones, the links will also be available in the platform. So tonight, as I said, we have two speakers. Please welcome Fernando Assad. He's a multi-asset and equity portfolio manager at Ashmore. And we also have Saul Henry, co-head of alternatives and multi-strategy at Wellington. Welcome.
Thank you. Thank you very much. Pleasure to be here.
It's a pleasure to talk to you guys. So just to kick off, so we are in the process of transitioning towards a post-COVID world. And tonight, we would like to discuss where are the opportunities to invest in emerging markets in this recovery phase. So for my first question that I have for both of you is around the performance of emerging markets this year. Coming out of the last crisis back in 2008, emerging market equities were one of the best performing markets, right? But this year, EM equities are lagging behind. At the end of May, MSCI emerging markets have returned 7.3% in US dollars, and MSCI World has returned 11.4%. So what I would like to ask you first is what's behind this underperformance, and what's your outlook for the rest of this year? Why don't you start, Fernando?
Okay, thanks. Yeah, interesting observation. I think lagging, perhaps strong word. I do remember back in 2008 and all the way to 2010, like that full recovery rally. MSCI EM was up around 120% from the lows, and S&P was up 80%. So I think from the lows on March last year, S&P was up around 90% or so. MSCI EM a little bit less, but in line with Europe and a little bit better than Japan. So top half of the pack. But I think what's happening here is back in 2008, the global financial crisis, the epicenter of the crisis was in developed markets, and EM was kind of like a little bit distant from it. It got affected, but you had China in particular coming through with a massive 4 trillion yuan stimulus package, which really helped EM economies get through this in a little bit more relaxed way than this COVID situation. In 2020, arguably, US and Europe are following those steps that China did follow during the great financial crisis. A lot of stimulus coming through. They're benefiting first. I think it's EM's turn next, but I'll pause to give Saul some time to say something as well.
Yeah, no, thank you, Fernando. But you make great points. I think it's that's right. There's been a bit of relative underperformance of EM this year, but the longer term context is that EM certainly has benefited from the reflation trade, the policy induced reflation trade that you talked about, sort of off the lows in March last year with the pandemic. I just maybe to dig into what you said, I think there are two other things that have been going on this year that have probably added to some of the concerns around the EM. One is, while we've seen a vaccine rollout, across a lot of, not all, but a lot of the developed markets, we've obviously seen some, tougher times. You think about some of the pictures we've seen in India in the early part of this year, in Brazil, where the case count has been, was rising in the early part of the year. I mean, thankfully now we are seeing it stabilize and come down. So I think part of it has been just more signs that while the developed markets are sort of moving beyond the pandemic to some extent, it's obviously going to be a longer process in some of the emerging markets. And then I'd say the second point that we've also been focusing on actually comes around the regulatory side, and particularly in China. There's been a number of situations where the Chinese government has been getting more involved in regulation. We've seen that in the financial sector with companies like Ant Financial. We're seeing it more recently in the education sector as well in China. So I think that sort of increased regulation has been another issue that has put some some sort of downward pressure or some concerns in the marketplace.
Perfect, thank you. Since we are talking about China and Asia, I would like to start talking about emerging Asia. So people have been talking a lot about the shortage of semiconductors around the world, and emerging Asia, so countries like Taiwan, Korea, are very important to the supply chain of semiconductors. So do you have any views of this industry? Is it something that you are invested in? So maybe you want to start?
Yeah, no, absolutely. I was just going to jump in. Yes. So, so I think there's two questions there. Two topics to dig into. Well, one is the semiconductor perspective, and then one is exposure to Taiwan and Korea. I mean, on that point, we have typically been underweight Taiwan and Korea, in part because we believe they are very much plays on the broader global economy. Those markets, although they're defined as EM, typically rely very heavily on the developed market growth cycle. And so they can benefit from that. In our portfolios now, we're much more focused on thinking about the longer term opportunities around the domestic emerging market cycle. So for that, we are actually underweight Korea and Taiwan. But what I would say within the semiconductor cycle, I mean, it has been there has been a lot of volatility. There's been some quite significant supply shortages around the pandemic. In part because the auto sector essentially shut down. Semiconductor capacity got moved towards other areas like personal computers, smartphones that were benefiting in the pandemic, and it's been hard to bring that capacity back online. Our view actually is that is happening. So there has been a supply shortage. That's a temporary phenomena. There were some weather-related issues as well, which caused some of the fabrication plants to close down. But actually, we think we're past the worst. And if anything, actually, we are actually invested in some companies very much in the supply chain for the auto sector, making semiconductors for cars. And as you know, as we move towards more towards electric vehicles, more towards autonomous driving, the semiconductor content of the auto is going to go up dramatically. So actually, there is a supply shortage. The auto companies are struggling to get semiconductors, but actually, if you're investing in the semiconductor companies, they're really benefiting from this environment, have got very full order books, very strong demand for their product. So actually, that is an area that we have been positively positioned for.
Yeah. Interesting points. The way that we look at Korea and Taiwan and any country in emerging markets really is we look through like a macro lens, looking through countries into the different industries and each company on its own micro merit. But looking at Korea and Taiwan specifically, the success that you see in the semiconductor industry really hasn't happened overnight or even in the last decade. It's pretty much a focused long-term industrial policy over the last 5 decades, really started in the 70s. Like centralized guidance, export focus for competitiveness, and cheap financing, competition, and getting better at the technology curve was really the key. So really, they benefited from 50 years of hard work for being where they are right now. So Korea, around 20% of semiconductor sales globally. Taiwan, 6%. You have these amazing companies that have been building this IP and building this ability to innovate for a long period of time. But I do remember when I started back in the 2000s, our senior PMs back where I worked there would laugh at one considering Samsung could really compete or be an alternative to someone like Intel. Now we have Samsung, TSMC, Hynix, MediaTek, all large multi-billion revenue companies in the semiconductor space in their own sub-industries, benefiting from this current structural growth path that Saul highlighted. Digitalization, cloud, automation, these have been already trends that we had seen pre-COVID. And what we've seen in the last 18 months is also a step change in terms of acceleration there. We do see this semiconductor shortage, chip shortage, primarily a reversal of their end clients running very low inventories in recent years, concerned particularly about the US and China trade war and what it meant for future growth. That has actually fully reversed, and now, when we speak to companies in the developed world, their end clients, and in EM as well, you see companies have decided to completely shift their strategy from just in time to just in case, and run larger inventories. And that is bringing a stronger market cycle right now, and that's actually constructive for the Korean and Taiwanese semi industry, we believe.
Perfect, thank you. Sticking with the emerging Asia theme, I would like to talk about India. So another very important country in EM that's also in the radar of EM investors.
Yeah.
It is a country that some may say that has a similar story to China. It is a high growth economy, but it is currently in a very different situation than China, since still struggling with COVID. Is India a market that you're invested in? And if so, what are the themes that you're looking at right now? So would you like to start?
Yeah, no, absolutely. So we do have exposure to India. And you're right, you can compare it with China in lots of ways in terms of the obviously a significant economy, by population. But I think in quite a different situation, in terms of the shorter term dynamic, as you mentioned, and as I talked about at the beginning, clearly, the COVID situation has had really quite a negative impact. Thankfully, it does seem to be on the improving track. And then I think taking a slightly longer term perspective as well, there was actually a really good reform story underway in India, sort of over the last 5 years with the Modi government, related to tax reform, related to sort of increasing, financial participation moving the financial sector more more into the banking system and less just cash transactions. Actually, quite a lot of progress in terms of improving the infrastructure, the transport and the logistics. And unfortunately, that has lost some momentum in the last few years. I think COVID is a large part of that. But I do think the ability for the government to really keep that reform process going did also sort of lose some momentum. So we've been much more selective in our Indian exposure. A couple of the areas that we're really focused on. We do think, and we can probably talk about this more in the context of all emerging markets, but climate change is a really big issue for emerging markets, but for India specifically, in part given their still heavy reliance on a rural population that relies on agriculture. So we're really sort of focused on how they're going to evolve their energy consumption. Unlike China, they've not yet really announced sort of aggressive moves to a net zero carbon, but they are sort of moving in line with the Paris Agreement. So we've been very much focused on the renewable sector, on how they can reinforce their electricity distribution network. So that's one area that we've been focused on. And then I think the other area links to this concept of more financial inclusion. I think one of the longer term trends that we're very excited by is basically getting financial services into the hands of many EM consumers who have no access to banking services. Over 1.7 billion consumers in the world don't have access. A number of those are going to be in India. But the benefit there is that actually 2/3 of the people without access to financial services do have mobile phones. So I think one of the benefits of the COVID situation is it's given us a glimpse on the future. It's given us a glimpse about how digital connectivity, mobile banking could really get those basic financial services, whether it's insurance, banking, just mobile money, get that into the hands of consumers who previously had no access to financial services. So in India, we're being selective. They're the two areas that we're focused on, financial inclusion and renewable energy.
Yeah, from our side, we have a team on the ground. We have a Mumbai office. So we're pretty close to the situation, both on a personal basis, and we do formally meet at least once a week to have a conversation about what's going on in terms of macro globally, which we include our India team. So they have I think been very right in suggesting to us to look through the headlines on the COVID side and look at the policy action that has been happening, and look at the trends in terms of the health services. So it has been a very tough situation, as Saul alluded to. But cases over the recent week or so have started to slow down from the 400,000 to around 100,000. In terms of luckily, there is a strong capacity from the health service and from the pharma sector in India to try to improve the situation going forward. And best indicator that we get usually is a capability of transforming like the raw materials for the vaccine into the vaccine itself, and being able to vaccinate the population. And that capacity has increased meaningfully over the last couple of months, from around 70 million vaccines per month to around 100 million now. So good news in terms of going forward, even though the situation is tough right now. Vaccination in itself, it had slowed down in the middle the second wave, which was a concern. But we already picked up by about 50% in the last 2 weeks or so, to around 2.4 million vaccines a day. Then in terms of economic activity, we're starting to see leading indicators pointing to already some rebound, basically mobility relaxation that we're seeing on some real-time data. Yes, and looking at Saul's discussion about some of the reforms, yeah, it's one country that has really gone through with a number of reforms, and I would add to Saul's point that we had, despite the pandemic, labor reform. There were like 40 or so laws, and now it's like 4 codes. We're gonna have the same situation, hopefully, in Brazil and other EMs in the future. But you actually had around 1,000 different minimum wages that are now going through a process of centralization, and you had around 85% of Indian jobs were informal. Hopefully, that mandated formal contracts plus the digital finance efforts that Saul alluded to will help a lot in terms of the financial inclusion side. They came out with a budget a couple of months ago, which was pretty growth focused, which is a positive focus on domestic infrastructure in particular. And so we're constructive. Now, they were somewhat lucky that they had a financial scare over the last 2 years before COVID on non-bank financials, which meant that there was a lot of deleveraging happening ahead of COVID. What we've seen on the banking situation is asset quality and provision buffers are quite benign picture, and we're starting to see the potential for a restart of credit growth and provision write-backs. So our focus is at the banks, and lastly, I would say the biggest risk and why we're not even more constructive on India is oil prices. Oil prices do have an effect on consumer spending and producer margins over there. So our focus remains looking through that country macro picture and preferring the bank's exposure at this point.
Perfect. So a little bit more selective when it comes to India, given the still ongoing challenges that we have there. Following up with the conversation about renewables and climate change that Saul mentioned, ESG is a theme that XP has been bringing to the table a lot. I think unfortunately most EM countries tend to be a little behind other developed markets when we talked about implementing ESG policy. So I know Saul talked a little bit about in India, but across EM in general, how is ESG evolving? Are there anything that you would like to highlight, or do you think it's just lagging behind?
Yeah, I think it's we got to look at ESG and looking at how we measure efforts and targets on the context of where economies are in terms of overall development and cycle. So I respect Saul's point on India, but when we look at it in terms of how much they have already reduced emissions intensity per GDP, they're probably the only country in the G20 that is above the targets already to achieve their budget. So they're around 25% reduction in intensity of emissions per GDP, targeting 35% by 2030. None of the other G20s are at those levels. So emissions have increased because the economy has grown overall, but at least that intensity and that target has been kept, if not beat by a large amount. Ashmore, as a firm, we recently published a paper with some recommendations, and the first thing is about measuring something like greenhouse gases, not just on an overall basis, but per capita basis, and looking at consumption versus production. Most of the developed markets outsourced all its production to emerging markets, but they still consume most of those emissions. So the net, on a net basis, the picture is not as the gap is not as I think as scary as it looks on a headline level. We did also suggest some ways to incentivize efficiency, and the other point is in terms of looking at a way to price better, like a carbon sinks in according to its social value. What we do as equity managers and analysts is to push companies across the board to not just really disclose more from an ESG perspective, but engaging into how to improve those metrics as well, and holding them accountable across our investable universe.
Yeah, if I can maybe dig into that, because Fernando raised some really interesting points there. I mean, I think moving beyond just the environmental side and climate change, but then thinking more about ESG and integrating that, I think ESG is creating some really good opportunities for active investors. I think there are a number of big structural changes that are happening now. The asset management industry globally is getting more focused on sustainability. Governments are more focused on sustainability. I mean, India, as Fernando said, has been focused on carbon reduction. China is doing that. We're seeing things like the UN Sustainable Development Goals. So there is a real opportunity around sustainability here, but then actually the data is quite hard to assess. And so we have a lot of companies doing ESG scoring, but actually don't necessarily fully capture the whole picture there. So very similar to Fernando's comments, we think an active approach is really important. We have over 50 equity analysts globally. And I think really working with the companies, the companies can get scored, based on their E, their S, or their G criteria. But often we found many examples where, we think those scores are not quite appropriate. And maybe to bring it to life, there's one company which is a China gas company, and obviously gas is a fossil fuel, but it is far cleaner than thermal coal. So, as a country like China moves towards net zero by 2060, a really important stepping stone is going to be shifting from coal to gas. Eventually, we get to solar power and to wind power, but that takes time to bring on board. So, this gas company is actually a very efficient gas company. It's really helping the rural population move away from wood burning and thermal coal, but yet it gets scored very badly from an ESG perspective. And yet, that's a company that we think is part of the solution. Equally, we own a Chinese wind company, which is clearly part of the carbon solution to move towards net zero, but it has some legacy fossil fuel exposure. Now, it's getting rid of those. It has a plan to divest from those, but at the moment it gets scored really badly. So for like a number of asset managers who don't have all of the details, or who are simply relying on those scores, or maybe ETFs that are just using simple scores to assess the companies, this company is uninvestable. Yet actually it will be probably one of the world's leading wind providers of wind energy, yet it actually gets scored quite badly from an ESG. So great examples there where I think ESG ratings are actually creating a lot of inefficiencies, not just in the EM universe, also in the global universe, but it's particularly apparent in EM, just because typically the data, the accounting has been somewhat less robust than we're used to in developed markets, and therefore it's harder to make these assessments. So I think our view is very much that there are ESG and the move towards sustainability is creating some really compelling opportunities for active managers who can do the extra research to really understand what's going on under the surface in the companies they invest in.
Yeah, I definitely agree with that. This I think it's very right in terms of for end clients to take advantage of these mispricing and opportunities to move away from just plain avoidance ESG, let's not buy anything on this particular industry or sector, to like engagement, accountability ESG. So I think we're pretty aligned there.
Yeah, so also brought some very interesting points that I think our ESG team at XP also mentioned, that there's no standardization of what and how companies have to report. So it's difficult to have a consensus of ratings. So that's definitely a challenging worldwide, not only in Brazil, but in other companies as well. Now, switching gears to another theme that I would like to talk about. So one very important debate that's been taking place in global markets is the rise in inflation and higher policy rates. So in the developed world, central banks are still discussing whether inflation is transitory or not, and most of them are still keeping monetary policy very stimulative. But as we all know, inflation is a concern in emerging markets, and central banks have already started to tighten policy to control the rising prices. Brazil is a big example of that. We are already in a hiking cycle. We have a meeting next week, and it has already started over here. So are you concerned about inflation and the impact of rising rates in emerging markets, especially in the equity market? So Saul, would you like to start?
Yeah, let me start off there. And this is probably a conversation that we can spend quite a bit of time on. I mean, I think that to us is the clear concern now in emerging markets. I mean, I think we have to balance that with the idea that there is still quite a lot of spare capacity, we believe, in emerging markets. So there is the scope for them to grow, but to grow without creating too much inflation. And obviously, inflation numbers are generally lower than we've been used to, which is a positive. But equally, we are very conscious of the enormous policy experiment which is going on globally. So, obviously, I think the US is maybe the poster child here of very expansionary fiscal policy, with a Federal Reserve that is prepared to really wait until we see signs of inflation before they really do anything. So it does feel like sort of somewhat uncharted waters for us. That the risk here is that there's a lot of stimulus in the world. That could create rising inflationary pressures. So I think we're watching the short-term inflation numbers. We've seen rising commodity prices. We've seen supply shortages, a lot related to the pandemic. The million-dollar question is that just, as you mentioned, a short-term rise in inflation and base effects that will then abate, or are we going to see more of these inflation pressures sort of pick up? And then the million-dollar question is, and then what is the policy response? Many of us will remember the taper tantrum of 2013. Obviously, I think there's a lot that is different. Things like the fragilities that were in the system, the current account deficits are in a much better place. At that point, the dollar was very weak, and it began a period of dollar strength, which was tough for emerging markets. So I think the starting point is quite different, but I think it would be, it would be foolish to say that there's not risk around that sort of inflation and interest rate dynamic. So it's something that we're definitely focused on. I might pause and just pass it back to Fernando, but I'm sure we can talk and debate more about this.
Yeah, it's clear, like in my head, the discussions that we had, myself and the team back a year ago virtually already, in Zoom like we are right now, but the discussions were about central banks in EM, and they did try to really lower short-term monetary policies, given the inflation was mostly surprising significantly on the downside for a little bit, and you had an extra negative surprise at the beginning of COVID, and whoever was closer to the market and closer to particularly like FX land at Ashmore was quite against moving to a too easy a monetary policy, while others thought we should try and run with it. The markets, bottom line, largely did not give EM countries the benefit of the doubt. And they started through FX weakness or longer-term rates rising to tighten monetary conditions, even when central banks were trying to run an easy monetary policy, really. And we have had, particularly through FX weakness, some pass-through inflation. As Jennie mentioned, Brazil is an example of that. Inflation has rebounded. But when we look at our internal research as a EM basket, inflation is back around the 5-year average of just over 4%, around 4.2. But what we have seen is that rebound came through early, before you've seen the rebound in developed markets. And what we've seen is ahead of developed markets, a lot of the central banks already reversing course in terms of a monetary policy. So the Brazils, the Russias, the Turkeys of the world already started increasing rates, and others have turned a lot more hawkish. What we see looking at inflation expectations around EM, they remain relatively well anchored, but a little bit above the lows that we saw in 2020. On the constructive side, on the more positive side, we have seen EM effects starting to stabilize after the little bout of weakness, and with the improving external balances and current accounts, as so alluded to, and the terms of trade improvements, you should see a more benign environment for EM inflation overall. Now, when we look at US inflation, where we had that CPI surprise of around 4.2% last month, our internal modeling suggests the highest linkages are usually with oil price and commodity prices in general, and commodity prices since then still suggest something like around a 5% print on Thursday. If commodity prices do stabilize, and we think the bottlenecks on the semiconductor side, which affect the auto side, will also bring some relief on that auto component of the CPI in the US, you could most likely see a decline back to around 3% inflation by year end. But all really depends on commodity prices. When you bring it that inflation to the interest rate environment in terms of developed markets, I will mostly agree with Saul. we don't see a repeat of 2013. First and foremost, because the FOMC did have a major change in policy, which they announced in the middle of the pandemic last year. They have changed their inflation mandate. They're going into average inflation targeting, which means less preemptive tightening, which for us, it should mean less dollar strength and more benign monetary conditions, as well as the dollar is stronger, EM FX is weaker, EM also exposure is a lot lighter in the global scale versus what it was back in 2013. And my last point is why rates rise in the US is as important as the level that they increase overall. I do remember back in 2004, 2006, US rates moved all the way from 1% to 5.25%, if I'm not mistaken. EM, it was a very good kind of a Goldilocks era for EM equities. EM equities were up 80% back then, I think around 4 times S&P, and that's because the global growth picture, not just US, was rebounding, and I think that there is a little bit more similarities to that, hopefully, than what you've seen since 2013.
Okay, so I guess the big question is, what will the Fed do? That's the million-dollar question. We do have the CPI coming out this Thursday, and it seems like markets are on a wait-and-see mode to see what's going to happen, and then what the Fed's going to do next week. Now, turning to politics, I want to talk a little bit about the political calendar that we have going on. So we just had a big weekend for politics in Latin America. So on Sunday, we did have the presidential elections in Peru, midterm elections in Mexico. We have upcoming 2022 presidential elections in Brazil. And when I did research in US, so before I joined XP, I worked at JP Morgan, and we talked a lot about politics in the US. And what we used to say is that for investments, what matters is not politics, but policy. And this one is much more difficult to change in the US, but that doesn't seem to be the case for emerging markets. Politics are much more important for markets when we talk about EM. How do they affect your views, or how should investors in EM approach them when investing in this region? Saul.
Yeah, I mean, I'll jump in there because my answer will be quite brief. And we are truly bottom-up investors. I mean, I think the way that we want to navigate these these macro issues, like the idea of the Fed tapering, and also the political cycle, is it's in our opinion, it is very hard to really have a true edge in assessing the risks around these political cycles. I mean, I think if you think back to the President Trump election of 2016, Brexit, often you can do a lot of research and it's quite hard to really understand the outcome, or where it's very obvious what the outcome is going to be, then the market is actually very efficient at pricing that in. So we actually, I like what you said about it being policy more than the politics. We spend a lot more of our time really understanding what the true sort of policy directive is, trying to focus in on those longer term, secular trends. So, I mean, I've talked about some of the things that we've been investing in, but like the move around renewable energy, the move around electric vehicles, what we're seeing on the healthcare side, trying to position more for those longer term secular trends rather than trying to sort of assess like the shorter term political cycle. Others may be able to do that better. I'll pass it over to Fernando to get his perspective, but we just feel it's very hard as bottom-up investors to consistently have an edge in trying to really navigate these political cycles very effectively.
Yeah, I think I guess we're blessed at Ashmore because we have such a large fixed income team, and macro thinking is how Ashmore was started, and just focusing on the global macro picture, and particularly in EM. And all the equity team has to have a little bit of that rubbed in through the decades of working over there. What we suggest, and it's interesting that around 3-5 years ago, when we spoke to clients, the view was generally like, politics doesn't matter. Policy is what matters. But what we need to realize is politics drive policy. And it used to be that it was just in EM, but I would beg to differ. Since Trump and since Brexit, I think the world has reverted to become more EM. And investors need to pay attention to what the politics mean, and particularly because of the monetary and now fiscal experiment that Saul alluded to previously. We are in a world of policy dominance, for better or for worse. We probably have some good policy enforcement coming through from a sustainability perspective, which I believe is very welcome. But we can't run away from some of the monetary and fiscal consequences that may come through from the developed markets perspective. So in general, what we see is a period of the market ignoring politics, and then the event comes near the radar, kind of 6 months before or so. That happened in the last Mexico election, the last Brazilian election as well, and then people all of a sudden overreact, risk premium build. Those that are experts, either through the macro lens or the micro lens, try to understand what the policy framework can change or not. And then we move on to the election time and probably harvesting risk premium. If we think about last year, and just the example of the biggest emerging market that actually emerged, the US, you had November, like this fear of anything possible related to the elections. And what you've seen so far is actually like that risk premium coming off, being harvested by investors that deployed capital back then into global equities and US equities. In the US, you have more rational foreign policy, and maintaining monetary and fiscal policy quite benign. Over the weekend, the Mexican midterms, I think it's been pretty benign outcome, more checks and balances, and possibly a realignment of Mexican fundamentals with the constructive connection that they have with the US. The Peru presidency is a tricky issue. I think it will remain confusing for the next couple of weeks. Hopefully less confusing than the US was in terms of accounting and whatnot. And then you have a number of elections coming through into next year. We have November Chile, we have March next year, like Korea, and Colombia and Brazil, etc. So each of these we treated exactly like in the same process. Try to understand when the market is ignoring it, perhaps lightening up position ahead of it. Really get boots on the ground virtually hopefully in reality in the coming year, and understand the policy framework and see where we can harvest that risk premium if possible.
Thank you. So we are reaching the end of our panel. We have 10 minutes left, but I have one last question, which is probably the most exciting question that I have for you guys. So what are you excited about emerging markets? What are the long-term mega themes that you're invested in looking over the long term? So Saul, why don't you start?
Yeah, no, absolutely. I mean, let me jump in on that. So I think we've touched on a few already. So we've talked about electric vehicles. We've talked about the move towards renewables. We've talked about the idea of sort of more financial inclusion and moving towards mobile payments and more digital payments. I think what's the key about all of these is they are not large parts of the benchmark. The benchmark in emerging markets reflects the past winners. It's the history. But as we look forward, it's those sorts of themes that we think have the real sort of potential return opportunities. So I mean, other areas where we're very excited by at the moment, I would say healthcare, and obviously healthcare today in emerging markets, actually in the emerging market benchmark, the MSCI EM index, healthcare is just about 5%. Now in most developed markets, it's 2 or 3 times bigger than that. So when we look forward over the next 5 to 10 years, we think that healthcare will be a significantly bigger part of the EM index. That market cap is going to go up. If you think about all the trends we're seeing around biotech, in China now, and all the patents that are happening there, all of the trends in terms of the learning that's happened around generic production and vaccines as a result of COVID. If you think about all the new technology around online medicine that has been used in developed markets, and maybe in developed markets, developed consumers will go back and see their physicians again once they can go back to hospital. But actually, all of that technology is going to have a massive impact in giving healthcare services to people in emerging markets. So we think that's an incredibly big opportunity. And then another area that I'd point to as well would be really around education. We have just all probably lived through one of the biggest social experiments of our lifetimes with the move towards online everything, but particularly online education. And again, I think companies involved in that have made groundbreaking strides forward in terms of how technology, online learning, even artificial intelligence and virtual reality can really come into the classroom and come into the online learning experience. So again, these are things that have maybe been tested in developed markets, but I think the future use cases will be much more in emerging markets. So if I think back on what we've talked about in the last hour or so, we've talked a lot about the macro, a lot about the politics, a lot about the Fed and when do they taper. And I think our starting point is we want to be long-term thematic investors. We don't want to invest our client assets in any company that's going to get impacted if there's a change in the political cycle or a change in the Federal Reserve cycle. We want to find companies that, regardless of what happens in the macro world, these companies are going to grow their earnings significantly faster than the market. And so we do that on a bottom-up basis. And I think we see a number of these themes that I've mentioned where we have high conviction that they're going to grow a lot faster than the broader EM market. And they're going to be a much bigger part of the market cap in 5 years' time. So that's what we do in a portfolio. We don't worry about what's in the benchmark. We don't worry about benchmark weights. We just focus in on these secular growth opportunities and then concentrate the portfolio there. So that's just some of the themes that we're currently invested in the portfolio.
Yeah, from my side, I think we can have really the luxury in EM through the diversity of 25, 27 different countries when you look at the broader universe and liquid areas in terms of 25 or so different industry groups. So there is always something interesting to deploy capital to, and where we're more constructive in is where you have that really alignment of a constructive macro environment with strong micro picture. So those fertile macro environments with a strong micro pictures where we want to deploy the client's capital. At the moment, some of our most constructive views are on semiconductors in Korea and Taiwan, which we already discussed a little bit. Banks in India and Korea as well. We're still have not seen the reversal of provisions related to COVID, and we're going to see a rebound in economic activity, which leads to loan growth as well. And some of these structural stories, particularly in the sustainability area of creating a cleaner, greener kind of a world, have to go through a increase in intensity of copper usage. So we're still constructive on some of these miners that meet our ESG standards and our lowest cost producers as well, and should be benefiting from this like 4 times to 5 times increase in copper intensity that we expect coming forward. And last but not least, a fairer world, I think, will include some of the winners of the digital financing world, which we know the XP knows better than most what that means.
Perfect, guys. We are at the end of our panel. Thank you so much for your time. It was an honor, a pleasure to be able to talk to you guys. And everyone, thank you for your time watching us. There's a QR code on screen. It leads to a survey for feedback if you have anything for us. So guys, Fernando and Saul, have a good night. Thank you for participating in this event. As I said, it was a pleasure to talk to you guys, and I hope I see you guys again later.
Thanks. It was a pleasure.
Thank you very much. It was a pleasure.